Okay, welcome everybody. Today's speaker is Tom Baker, who really does not need an introduction. Pretty much everybody here has to know him. He's written at all scales about insurance, from the micro to the macro. He's written from many different disciplines, from law and history and sociology and behavioral economics. And he's here to talk about his fascinating new paper, which was joint with Anja Shortland, who I can also see her name up there, uh, about insurance and crime. I'll just say that 2 weeks from now, we hope you all join us for Omri Ben Chachar, who's going to be talking about personalized insurance. Tom, the floor is yours. Take it away.
Okay, great. So I'm going to see if I can manage to share my screen. I have slides. Um, and I want to, emphasize at the outset that this is totally joint research. And in fact, it was Anya who noticed when we did our papers on our earlier papers on cyber insurance that we were identifying something that seemed generalizable and that we really ought to not bury that point in one of the other papers, but make a new paper out of it. So definitely wouldn't have been. So just for people that don't know, I've done a lot of different research, and Anya's written 2 books that if anyone on this hasn't already read them, they definitely should read them. One about the kidnap and hostage for ransom business, and then another about art theft. And in both of those books, insurance plays just a huge role in making markets possible and in governing crime. And we draw a lot on that research in this paper. And and the basic idea here is that crime and insurance are sort of in the criminals and insurance companies, or criminals and insurance organizations, which may be collective organizations on behalf of the industry, are in a kind of dialogue about crime. And that these, we first came to this realization, or realized that we had something generalizable in the process of writing the 2 papers whose little abstracts are focused, on the screen here. And the first paper looked at how government helps make insurance markets possible in ways that are sort of different or complementary to the sort of traditional safety and soundness and market conduct regulation. And then the second paper did a deep dive into ransomware history, and it was there really in the process of writing the second paper that we pulled out this binary star metaphor that is really Ken Abraham's idea in the context of the Liability Century book, which is another book that if anyone on this call hasn't read, they really ought to. And so what we do in the paper is we walk through 5 different case studies that I'll talk a little bit about each one today, and examine both support, we think, and examine the proposition that insurers act to govern crime to keep it insurable, and that we identify things that they do that make it more costly to commit crimes, things that they do that limit the profitability of crimes, and things that they do that increase the probability of detection. And we're very much in this paper operating from within a sort of institutional economics framework, and what we view ourselves sort of additive to the Baker view of crime, which is a very rational actor, expect utility theory approach to crime, and that we just are bringing in a sort of additional actor beyond the state in kind of explaining the level of crime. And so we, I think not as clearly in the draft of the paper that was distributed to you guys, but more clearly in the latest draft, we have we got what I would describe as a very significant, substantial revise and resubmit from the Journal of Legal Analysis that really forced us to kind of do a better job of articulating what it is that we think we figured out. And so we think so this presentation is kind of a new and improved approach to the paper. And so we, as says here, we see them, we track them in 3 dimensions with insureds, and they're, it's classic moral hazard solution type things of partial insurance, and then loss prevention mitigation conditions. And interestingly, we find these to be the least important are notable things that we observe. And then they're also engaging with third parties, and the third parties are both legal and extra legal. The legal third parties that we're talking about here are the research organizations that they help to fund, principally. And these, they fund, and, the deeper we get into each of our case studies, the more we find insurers funding and supporting technical solutions to both harden targets and improve recovery. And then they engage with the state, both by providing advice and training. Here, auto is going to be our best example. In some cases, they even co-fund enforcement efforts, and in almost across the board, we find them lobbying to increase enforcement and or require solutions that harden targets. And that with much of this, or at least the second and third, with engaging with third parties and engaging with the state, we can think about the insurance companies as helping to solve collective action problems. And sometimes, they can't, the competitive nature of the market means they can't solve those collection action problems through voluntary activity on the part of the insurance industry. They, collectively work to get the state to force everybody to do something. And that's, at least for me, was a new kind of understanding of how insurers can solve collective action problems. And, I'm used to thinking about insurer lobbying as really rent-seeking behavior, which I think it is in many cases, but it's not always rent-seeking behavior. Sometimes you can even understand insurers to be sort of almost like the agents of their policyholders by making, in this aim, reducing crime. So we're going to start with, our case studies are auto theft, art theft, kidnap and ransom insurance, ransomware, and credit card fraud. And so what I'm going to do is, hopefully to leave plenty of time for discussion, is I'll run through each of them. And we're going to start with auto theft. And that, I had always known that there was heavy duty involvement of the insurance industry in really everything to do with auto, but I hadn't realized until we did this paper just how far back in time it went. That it goes, all the way back to the beginning of the 20th century, when insurers set up these crime bureaus. And the crime bureaus really were a function of the fact that policing is local. And so once, someone steals a car and drives across the county line, you're like into a whole new universe as far as the police are concerned. And so these crime bureaus started by tracking serial numbers for cars, so that, and when one was reported as stolen, they would report the serial number of the car and maintain it to be available to other insurance companies and to law enforcement. So it would be a way of identifying a stolen vehicle. And eventually those crime bureaus that were organized locally, they became regional and then eventually national. And they're now centralized in the National Insurance Crime Bureau, which is funded by the insurance industry entirely, and does a whole variety of things, including training police officers, and even co-funding enforcement, not by literally, giving dollars to police departments, at least not that we're aware of, but that providing bait cars and other sort of equipment at no cost to the police department, so that they can do things to collect, to try to stop crime. And one of the stories that we tell in the, we really, I'd say there's two significant stories that we tell in the auto theft section. One is a story about how immobilizers explain the dramatic reduction in crime starting in 1992 that's shown in that little pink diagram. You don't need to see the dates, but that's a picture of auto theft over time. And at a peak in the early 1990s, it then declined dramatically with the introduction of immobilizer technology. And as Anja figured out, is that immobilizer technology dates all the way back to 1919. There's the first patent, but there's no take up for it. That crime was this sort of it wasn't worth it for anybody, including the insurers, because people were paying their premiums and they were earning their returns. But then in the early 1990s, after the sort of Iron Curtain opened up between East and Western Europe, there was a huge rise in auto theft because people could steal a car in Germany, drive it across to one of the former Soviet Union states where they could, basically do anything they wanted to it without it being anything happening to them. And so there, at that point, the insurance industry and went into overdrive to improve and eventually mandate the adoption through government action, mandate the adoption of immobilizer technology. So that's one story they would tell. It's very sort of nice, well, in a way, a nice story. I mean, of course, they were tolerating it. They weren't encouraging mobilizers for a long time until the shock, and then they were encouraging mobilizers and eventually achieved their goal of mandating them. The other story we tell is about VIN switching or the salvage switch, which is a phenomenon in which in which a criminal will buy at an auction a totaled car and then steal an identical car. Maybe it might have a different color, but it'll be the same model, make, year. And then they will take all the VIN information, anything salvageable with the right VIN on it from the one vehicle and put it on the other vehicle, and eventually, try to sell that stolen vehicle as a legit car. And that in that circumstance, when that practice became known, sort of consumer advocates realized that these people are buying these totaled cars at auctions that are run by insurance companies. And so they suggested to, various policymakers that insurance companies shouldn't be allowed to, they should be trashing those totaled cars, not selling them for money. And the insurers responded, basically, that's not rational. There's lots of legitimate uses for totaled cars, for parts and other things. And so we're going to keep doing it. And then someone proposed the idea of a new salvage title, a title that would indicate that a car was totaled, and that when you sold the car, it would be sold with that special salvage title. And the insurers resisted that initially because that would make the cars worth less at the auction. And at that point, you could say that's an example of insurers not in doing the right thing. Because of their self-interest, but eventually the larger insurers, State Farm being the leading one among them, which had a huge market share, eventually agreed that they would, approve this idea of a salvage title, and so they got behind it. And that, and that's an example, like in our view, of insurers sort of resisting change when it wasn't in their interest. And so this is a chart. One of the things that was not in the draft that you guys read is these little tables that we have now that we think do a nice job of explaining kind of over time what happens. And so, you can see each of the dimensions. There's the insureds, there's the third parties, both legal and extra legal, and then the state. And we, somewhat arbitrarily, we break up the auto story into the early, I don't know when that's like pre-1940, maybe mid, which is, until the maybe 1990s. When immobilizer technology comes on, and we see that, and then we've identified each of the columns as a different thing that insurers do. They can, the column one is with insureds, and those would be your traditional moral hazard type of solutions. And then underneath third parties, legal and extra legal, there's the idea of helping to either creating themselves or funding the creation of technical solutions to crime, mostly around hardening targets. In the auto example, we don't have examples of them incentivizing damage limitation, incentivizing criminals to not damage the cars. But we do see them promoting salvage and recovery efforts. First the registers, and then as we've documented, insurers were deeply involved in going from serial numbers to the VINs, which you can think of a VIN as being kind of a universal numbering system that replaces the manufacturer by manufacturer serial number approach. And they were also involved in, requiring in lobbying the government to require VINs to be stamped and then stamped in lots of places. And those same mechanisms do limit the criminal profit, because if the car can be more readily identified as stolen, it's worth less. And then in relation to the state, we've all the way back to the early days, the insurers are providing information and training law enforcement. And then, in more recent time, we've identified that they donate bait cars and provide other things. And then as we said, we've tracked them lobbying for VINs and titling changes, and then also for the adoption of the mobilizer technology. So this is, the idea is this is a picture that will allow us, as you'll see as I go through the case studies, to compare and contrast the developments over time. All right, so our next, how do I go forward? Yeah, so the next example is art theft. And for this one, so auto theft, I was just amazed to find that there's not like a good study of the history of the insurance industry involvement in autos. And in fact, Anja and I have that queued up as maybe one of our next projects, is to really tell that story. But with regard to art theft, Anja's already written the book, and it basically tells the story of the development of something called the art loss register, which is, you can think of as kind of like a private VIN for art. And so in the art context, we separate really just into the early and later period. And what we see is that, in the dimension of working with insureds, there is soft and harder requirements of security systems and alarms. And then, a hard requirement would be, I'm not going to issue this insurance unless you have them. This is soft, a soft condition would be, here, you get a discount if you do it. And Anja, in her book, or actually in the paper, we documented that they were doing both of those at different times, and with increasing sort of sophistication in what was expected. In part, as you can see in the technical solutions column here, the insurers were, involved in funding research and development of better security systems, and then also in developing because an alarm or security system is in some ways only as good as the installation, and so that they not only developed or funded the development of security systems, they also developed, this is the especially something called the Thatcher organization, which is a British insurance kind of research and development group. They developed standards for installation. And then more recently, there's an effort to involve trackers, although as the paper describes, that's a little bit of a tricky thing, because if you embed a tracker into a frame, that encourages the criminals to take the art out of the frame. And that could involve, especially with an older piece of art, it could involve wrecking the art, so that there's an interesting dynamic that we describe in the paper about that. And then here, where we do see things where they're incentivizing damage limitation that we didn't see in the auto context. And by that, insurers, once, when art is stolen, the insurance company pays the owner. And at that point, the insurance company would, like to get it back. And they developed mechanisms, somewhat extra legal, to get it back, either a finder's fee or, in modern days, a ransom, and that, those aren't payable unless the art is intact. And, that's obviously, as, we'll talk more about in the context of ransom, of the KNR and ransomware, there's a, if I'm providing an outlet for that art, then maybe that encourages its being stolen. And but on the other hand, if I'm willing, if I have a good system for paying a finder's fee or a ransom, then I'm going to be able to get the art back in good condition. And then there's different, and salvage and recovery is sort of related. I mean, but in terms of the salvage, the tickle that we described there is an example of a way to get a finder's fee. And then the art loss register, which is a mechanism for basically tracking the provenance and legitimacy of transactions in art make it, that if the art is registered in the art loss register and then it's stolen, then if it shows up somewhere else and if the person checks the art loss register, then it's identifiable as stolen, and that means they can get it. And also that, as indicated in the next column, that does limit the criminal profit, because if something is readily identifiable as stolen, then it's less valuable. It doesn't mean that there aren't people that won't buy it and keep it in private, out of view and so forth, but it is less valuable. And then vis-a-vis the state, there's various things that they have done to provide assistance, and then more recently to lobby for what we're calling special art police. And so far as we're aware, there hasn't been co-funding. But again, as with auto, we see, we see things in each of the dimensions, albeit not exactly the same. And that's, one of the benefits of this framework is that you can compare. Then next case study is kidnap and hijack for ransom. And here we're entirely drawing on Anja's kidnap research. And, I'll just go through that really quickly so that we have plenty of time for a discussion. But that in the, what's the kidnap and ransom market is different from any of the others we'll be looking at in sort of small size and club-like nature of the art of the insurance, which allows, as again, Anja's book goes into great detail, allows for a sort of collective action in a way that is not possible in a more competitive, larger market. And on the dimension of the insureds, that in the early days, really, there were no effort to sort of require insureds to do things, or but one thing they do is that they require that there's effectively a requirement that they have to follow ordinary care, or else they're going to be sued by their by the families of the people that end up being not recovered. And so through that mechanism, there's an obligation on the part of the insureds to follow security advice, and then insurers may even require that. And similarly, more recently, there's been not only do you have to follow advice, but you have to engage private security. On the technical solutions, all we've got on the column here is that they provide sort of up-to-date, fine-grained security advice through their vendors. I think that's something that we should expand on a little bit. In the incentivizing damage limitation, again, just like art's not valuable if it comes back broken. Well, obviously, if you don't get the hostage back alive, that's not good. And so there's a whole protocol around making sure that the kidnappers provide proof of life, and then they engage in sort of what's known as disruptive bargaining, which is designed to make sure that people don't overpay for ransom, and also make it costly, because you can't, if there's a reliable requirement of proof of life and you can drag out the negotiation, it increases the cost to the criminal of keeping the hostage, and also increases the likelihood that the law enforcement will get involved. And so those two things both operate to encourage the criminals to return the person sooner. In the beginning, they didn't do a lot of salvage and recovery themselves directly. It was all through the family, but now they can arrange for the payment of they can arrange to make the payment, which is not easy, and to extract the hostage, again, not taking them in a kind of like rush the scene and steal the hostage away, but just collecting the hostage after the payment of the ransom. And then in relation to limiting criminal profits, there's a whole protocol around disciplining the amount of the ransom that when it breaks down, as Anja describes in the book, leads to sort of dramatic expansion in hijack and ransom, hijack and kidnapping. And then in relation to the state, it's there's less involvement with the state, frankly, in this area than in others, in part because since there is more like club governance on the part of the insurers, there's less need for the state, but they do provide assistance in the form of information, and they they co-fund by, helping to pay for security so that the security that people who are protected, operating in these, um, you know, difficult areas where people are able to be taken hostage. The security is a combination of public and private. And then they do lobby occasionally. When things break down, they will lobby the governments to kind of go in and help with the enforcement. And again, Anja's book explains this, tells you all you want to know about that. Next case study is ransomware, which is the topic of the first two papers. And with ransomware, we, I mean, I would say that the big picture thing around ransomware to realize is that cyber insurance was a thing quite a bit before ransomware became a real problem. And, as we explained in our enterprise paper, that meant that cyber insurance was set up to basically prevent or to minimize the possibility that the people whose data was stolen or locked up would be sued for privacy and other violations, and less focused on preventing the actual ransom ransomware. They just it made sense to pay the ransom really fast and get the data back and do everything very quietly, hidden by attorney-client privilege, in order to minimize the possibility of liability. And that set up a dynamic that helps explain why ransomware went crazy in the last 6 or 7 years. But when you look at this over time, we see that the insurer we have. I mean, we've been interviewing people in the computer security world, and they explain to us that the insurers that have in fact been helping to fund the activities, including developing decryptors, encouraging mechanisms for backups, antivirus software and security settings. I mean, all these things are, marketed by, public companies and so forth, but these companies are basically using technology that was developed in research organizations that were funded, in part by the insurance industry. And so anyway, you can see here on each of the dimensions what we have the insurers involved with, not necessarily doing it themselves, but funding people that do. And then, one of the things that we find interesting about ransomware is now that it's seen to be more or less out of control, there's just heavy duty lobbying by insurance organizations to get the government involved, including even the possibility of the government involved what? The government involved so to make it insurable, and providing a government insurance backstop makes ransomware insurable, even if it might not be insurable all by itself, and would be another example of our sort of insurances doing what it does for itself, not necessarily always for the public good. All right, finally, credit card fraud. People might say that, gosh, that's a kind of weird example. There isn't insurance in credit card fraud. Well, we say, yes, there is insurance. It's just the insurance is embedded with the credit card that you buy. It's, as people on this, I'm sure, are quite aware that, U.S. law limits your liability for credit card fraud to $50. And what does that mean? It means that effectively the credit card companies are providing insurance to you. And it's this little picture says one of the things that's different about, so let me back up for a minute. So therefore we envision a credit card company as embodying both an insurance aspect and then a payment mechanism aspect. And it's obviously one embedded product, but the thing that's different about a credit card is because it's both the insurance and the payment mechanism bundled together. One of the things that the insurance payment company can do is to change the insured's behavior by changing the object that the insured is using, so that one doesn't have to persuade the insureds to use cards that have first signatures and then these little strips and then the little 3-digit code and then the little chip. You don't persuade them to do that. You just issue them and renew a new card and terminate the operation of the old card. And so that is sort of an element of insurance governance or crime governance that's not possible when you're not when you don't have the product embedded in that way. So on our chart here, you can see that dealing with insureds, that all along they've had the ability to update the cards, improve security, and then there's other and here the insureds are there's also a card not present rule, and that's really governing the merchants, not the insurers. We haven't really figured out a good place to put that on the chart. Maybe it arguably fits on the technical solution side, but as I'm sure you guys know, there's different rules for what the liability is of the merchant when they sell you something when the card's not present than when the card is present, and that's designed to encourage merchants to prefer having the card present. Because if the card's not present, obviously there's greater possibility of fraud because there isn't that chip or the strip, so forth. And in each of the, I will stop soon, and I won't run through all these, but you can see that along each of the dimensions, other than salvage and recovery, because if you think about it, it's all money, so there's not like some object that you want to recover. So it's not surprising that this column is empty. And then with regard to the state, credit card fraud is a crime, and so that the insurers, the credit card companies / insurers provide information about that when they, and then they and here we do have an example of a co-funding, that there's the payment fraud units that are co-funded by the insurance industry, and there the lobbying has mostly been in the direction of sort of more enforcement. All right, so wrapping up so that we have a little bit of time to chat. So what do we see? We see that it's a process of co-evolution, that with changes in technology by the insurers and other people active in the crime prevention world, we see innovation on the part of criminals. And when all of a sudden losses become sort of greatly increased, think the fall of the Iron Curtain, the rise of ransomware as a service, that stimulates innovation on the insurance side. And we have a hypothesis that I don't really know exactly how we would prove this, but we are developing the view that greater efforts across more of the dimensions stabilizes the system. I'm not sure how we would prove that. I'd welcome ideas about that. And we think we've shown here that through these case studies that insurance is not just purely a risk transfer mechanism. And obviously, other people, Omri's on this call. He's, written about that. But that we certainly provide more evidence that insurance builds institutions and drives policy. We've identified, I would say, some new examples, not in Omri's and Kyle's paper, where we can see that the insurers are involved in developing security development. The other thing that I haven't emphasized as much in the talk, but that we do in the paper, is that, that insurance governs crime in the interest of insurance being insurable, not in the interest of crime being minimized. And so therefore, you could say there's some governance gaps here. So when crime's not an insurance problem, in other words, when the level of crime is at a level that is insurable and people can pay their premiums, the insurers are not particularly motivated to do a lot about it. The example, the credit card, insurers, the card issuers / insurers were very slow to adopt the latest technology in credit cards, in part because they thought it was going to discourage usage and discourage merchants from accepting their cards. And similarly, even though the immobilizer technology dated all the way back to 1919, it wasn't until there was the explosion of car theft in the 1990s that the insurers got motivated to try to both push for the mandating of immobilizers and also work to identify standards for what were going to be good immobilizers, both of which they were involved in. That's from an insurance perspective, it's a rational decision. I'm not sure that I want to go so far as to agree with Ronan and Ariel that's the dark side of insurance, but it is, a way in which insurance is not, the governance gap is a rational thing. Second thing, we see is that sometimes there's a trade-off between frequency and severity that we, if it might be okay to tolerate a lot of small things instead of, in the interest of avoiding a really, serious outbreak. And again, I didn't do a good job, I think, of explaining the examples in this talk, but they're in the paper that, both in Piracy, Art Theft, Kidnap, and Ransom, there's examples of insurers sort of putting up with, you might say, low-level, insurable, but more frequent examples of these things as a way of, containing or avoiding the risk of some really bad things happening if the insurers weren't involved in the process. And, that is maybe not the same trade-off that a government might make. And then, the other thing is, if you look in this, the insurers they're going to focus on the bigger problem of the things that they're insuring. So what do I mean by that? So I gave the example when we were talking about ransomware of how insurers, because cyber insurance covers a lot of things other than just ransomware, and most of those other things benefit from sort of allowing someone to get back to work really fast and keeping it really private. Insurers for quite a long time just would quickly pay the ransom and not tell anyone about it, in order to minimize the liability of the policyholder to either its third party contracting or to the people who might sue it for privacy breaches. And so that, is again rational behavior from the part of the insurer that, maybe isn't a good idea from the public policy perspective. And Dan Schwartz and Joanna Wolf and some other people have written about that, and encourage you to read their papers. And then finally, sometimes there are collective action problems that the insurance company just can't deal with. And much of the cyber insurance research, at least early on, was sort of well, first there was some overpromising about what insurers could do in the way of preventing losses in the cyber context. And then, when that was shown not to really be what was actually going on, then a lot of complaining about how insurers aren't really doing the kind of loss prevention that we think they should. And, that it's a collective action problem. If insurer A doesn't require all these complicated things for the policyholder and insurer B does, and they more or less charge the same price, then gosh, I'm going to go with insurer A, not insurer B. And same thing with in the hijack market. So that's so what does that mean? So insurers, that there is crime governance, but the crime governance is rational in the direction of making things insurable, not in terms of minimizing the overall loss to society. And so here's some takeaways. And I always like referring to Carol Heimer because I feel like people sometimes don't adequately remember that she kind of kicked all this research off way back in 1985. And as she said that she took up the book title of her book is Reactive Risk and Rational Action. And, this could be a chapter in that book practically, what is it, 40 years later. And, crimes are reactive risk. What does that mean? It means that that what insurance does is affected by what other people do. That's the sort of classic moral hazard situation. And, both first party moral hazard and thanks to Peter and Gideon, we now have a different word for the third party moral hazard. And, both are obviously quite present in crime. And what's interesting with crime is you've got obviously a lot of third party moral hazard possibility. And so that's what much of the, governance that we've identified, tries to tackle. And, as I said before, insurance governance, it follows a market logic. It's not about minimizing crime. It's about sustainably insurable crime. And where are we going to find that? We're only going to find that when there are people who are able to pay for an insurance, and we're only going to find that for profit-oriented crime. So to the extent we want to think about private governance through insurance companies, we're not going to find it when it's crime against people who don't have income or assets to pay for the insurance. And we're not going to find it when it comes to crime that's not motivated by profit. So, here I'll refer to Jenny Regan's work on domestic violence torts and why there's, why aren't those torts, because there's not insurance of those torts because insurers can't deal with emotional or other kinds of crime that aren't based on profit. And then, of course, there's not going to find insurance as governance in a circumstance where the insurers have decided there's just too much moral hazard or catastrophic risk. And then the final point, and then I promise I really will stop talking so that we can talk about this, is that, the crime insurance equilibria can be unstable. And whether it's technological, legal, or other developments upset the existing equilibria, and we find interesting responses. And I think that's whether it's a binary, the binary star image is an image of something that's relatively stable. And what we're finding is that there's two, that insurers and criminals are two players, but it's, I think, a less stable system than the one that Ken identified in the tort context. And so that with that, I'm eager to get people's questions and reactions.
Awesome, thank you. So please chat me your question, or now I can see people, so you can raise your hand. Most people I can see. If you have your video on, I certainly can see you. Anybody?
And if Anja's on, let's see if Anja's going to.
Oh yeah, all right. That's a great idea. Anja, would you like to respond, dissent, concur, or something else?
I'm here, but it's very late where I am, so I'm just a spectator for tonight, if that's okay.
Of course, it's okay. That's fine. Get some rest. So, Tom, can I just ask you about the governance gap point that you said? Well, there's going to be dissent about standard setting. I mean, is that part what it is? That I didn't hear you say this, but that anytime you have to pick a standard for anything, whether it's 2x4s or computer chips or whatever, there's going to be some firms will prefer this standard because they have a comparative advantage in doing it this way. Some prefer that standard because they have other reasons. Is that an issue in any of these things where they just can't really agree? They would all like to have a standard, but they just don't agree on what the standard should be?
Well, when we first were thinking about this concept of a governance gap, we were meaning something more, I think, simpler than that. It's that there are some areas where insurers are simply not governing. And this is against the backdrop of, I would say, some people kind of getting overly excited about, the work that Omri did, or that I and others have done, sort of showing how insurers can do loss prevention, and then kind of being upset about the fact that there's not as much loss prevention as, we would like. And so that we can't think about insurers as being a complete replacement for the state, but it's just a complement to the state. And so, when we're talking about the gap, that's mostly what we mean. And I mean, that's what we were initially talking about. But you could also say that there could be a gap where, if the insurers could get their act together, it would be in their interest to do something, but they can't because they can't agree on what the right thing to do is. And that would be a different kind of gap. And I would say we haven't focused on that kind of gap, because that feels like just a sort of standard collective action problem, and less one about the capacity of private governance to work at all. I don't know. Does that make sense?
Totally. All right. So I have Laura and Travis, and then Ken Abraham.
And I thought I saw Dan raise his hand.
Oh, that was a personal hand, not a WebEx hand. All right, and Dan. All right, Laura, Travis, Ken, and Dan.
All right. Well, I wanted to make sure Dan got to talk if he wanted to. I loved your paper, and talked about it last night with a couple of people, and they gave me this whole history lesson on private industry policing itself before the cops did a good enough job that they felt like they could turn it over to the police. The Bankers Association used to hunt down bank robbers. The brand people still do that with cows. The art world probably has a little different way of hunting down people when it's an inside job. So they were giving me all these examples, and I was just thinking about in Minneapolis, Target has this huge building where they study loss prevention things for their store, for shoplifting and stuff like that. How the NICB, when they, as you looked at that and started looking at how they developed that, I think that the way that they connect claimants who skip from farmers to Allstate to whoever to make sure that they know this is like a serial claimant, professional plaintiff type person, that they're doing something that I don't think you can trust law enforcement to necessarily spend the money and effort on.
Right.
So what do you think the relationship is as far as industries where they just don't feel like law enforcement does a good enough job or isn't specialized enough compared to whether it's a relationship between the criminals and the insurance company?
Well, so that's very interesting. I mean, we thought about for our case studies, should one of the case studies be insurance fraud? And we decided not to do it because it is like what you said. In other words, that's the industry policing, protecting itself against its own, of which is, obviously super important for all the reasons that you described, but that it felt like a different story. It felt like, an industry policing its own, protecting its own from crime directed explicitly at the industry. Whereas what's different with the case studies that we decided to use was that this, and maybe credit card might be a bad example, might have fit, sort of more like that, because that is. So leave credit card aside for a moment. Each of the other ones is insurers kind of protecting someone else from crime, but of course they're incentivized to do that because the main way they protect them from crime is by indemnifying them from the crime loss. So therefore that gives them an incentive to go out and protect it. But I, from the perspective of private governance, this is just one piece of that the sorts of things that you mentioned would be other examples. And now that, I guess I might really have first thought about it in response to this question is that our credit card fraud example is an example of the industry protecting itself against the crime. And it's just that there you've got the industry and the insurance sort of bonded together within the same product.
Great. So
It was really
Travis,
enjoyable. So thank you.
Oh, thank you.
Travis, you're up.
All right. So I also found this paper fascinating, and one of the things that was most surprising to me about it, at least in the draft that I read, was sort of not as emphasized as maybe it could be. So the proposition was that if I read it correctly, was that insurers prefer criminals to be both organized and consolidated, because that makes the crime they commit more regular, less correlated, more insurable. And presumably governments prefer the opposite. They prefer disorganized, disjoint criminals. And so I got the impression that the suggestion was that the insurers are on the margin encouraging the consolidation and organization of criminal enterprise. I mean, and that would be intuitive in the case of like ransom or piracy. And so, I mean, but is that?
Well, it's interesting, sort of the economics of crime literature thinks that government also prefers organized.
Okay, so I mean, then I was wondering whether that's the case. That's not obvious to me either, but that's I guess a separate literature.
Yeah, I mean, so that was, I mean, and we're not taking that on. Like, we don't want to take that on. It's a sort of it's a better understood thing that we don't want to take on.
But then it's a doubly counterintuitive point that insurance is having the beneficial effect of creating more organized, more consolidated crime.
But on the other hand, it can engage in so let's pick autos, for example, that in the auto context, or are really kind of almost across the board, it's not that they prefer it, it's that they with sort of opportunist amateur stuff, they can be stopped through technical solutions. Whereas with organized crime, it's like whatever technical solution you come up with, they're going to be able to do something in response to it. Like even immobilizers. I mean, there's these sort of things that'll spoof immobilizers and so forth. and so maybe we haven't kind of spelled that out enough, but the idea is that insurers are able to deal with disorganized crime through simpler technical solutions, and also with ransomware, that it is at least until their development of ransomware, it's a service where then any idiot can do ransomware. But before that you could, by encouraging sort of very minimal security things, you could stop ransomware. But anyway, I think I guess my reaction to that is that we need to be more clear about that in the paper. And probably I need to do a better, and probably we need like 2 sentences on why this idea of insurers preferring organized crime is like governments preferring organized crime, at least as understood in economic theory.
Ken.
Hi, Tom.
Hey, Ken.
Hi, everybody. I asked not to be the first question because this is a little bit off point. I think this is a great paper and it stands on its own, and my question is not in any way a suggestion of anything you should do with this paper. But I always want to bump things up a level of generality.
Right.
And so, I'm wondering what these phenomena that you're identifying are a subcategory of.
Mhm.
We already have, let's just postulate, apart from insurance company lobbying, there are speed limits, right? And they help to reduce loss. So that, there are cultural forces like people increasingly frowning on drunk driving, that affect it. So, I don't want to trivialize it by suggesting that this is a subcategory of things that reduce insured loss. But
Right.
but I am wondering. While you were talking, I went back and found something I had saved when Anja gave a talk to the British Insurance Law Association a year and a half ago, and I think it might have been about one of your joint papers. But she had in it a PowerPoint slide with a 3-dimensional diagram. On one axis was regulation, which might be prompted by insurers or not prompted by insurers, right? On another axis was government backup. On a third axis was risk reduction, which was in some sense, bumping it up at least a level of generality.
Right.
So I don't expect you to have an answer to this, but when I hear you doing your, very interesting, I guess I'd call it ethnography, even though you weren't interviewing people,
Right.
I want to say, what broader lessons does it teach me? And I'm just speculating about what that might be.
Yeah, I would say, I mean, I don't have an answer. Obviously, if I did, I'd put it in the paper. But what I'll say is that I think we're going to get at an answer that, this is a project that was really ground up, I guess. And so in that way, it isn't like ethnography. In other words, we were writing about ransomware and observing this phenomenon. And then, and Anja had written about art, and she'd written about, K&R market. And I said, well, gosh, if this is really generalizable, it's going to be visible in auto too. So then I dug into auto. And so, in the kind of theory generation stage, we're at the identifying an interesting phenomenon and categories of, some taxonomies of how to compare it across one, but exactly what it means, or to put it another way, what this is a subcategory of larger thing, I would be the first to admit that we're not all the way there. And I guess I hope that the Journal of Legal Analysis thinks we made enough progress that we don't have to submit it to someone else afterwards. So And if anyone on this call, I mean, obviously the whole reviewer process is anonymous, but if anyone on this call has involved in that, please help us out here.
Dan Schwartz.
Hi, so I'll just jump on the bandwagon. I really enjoyed the paper and the project. My question, and relates to the issue of when is it that you said when losses are sustainable, insurers have much less of an incentive to move. Then when they become unsustainable, they don't. And I'm just wondering if you can unpack that a bit more, because one of the things I think about a lot, and we've talked about this before with climate, is sort of like losses are sustainable in a way, even if they are increasing pretty
Right.
significantly in a gradual, predictable fashion.
Right.
And so with auto, was there a change in sort of the predictability of the risk that you think may have been part of the shift by insurers? Was it sort of
Yeah, it's interesting. So I think it might have been, I think it was less about predictable and more about magnitude. And as you know, auto insurance rates are very politically salient.
Yeah.
And so there, something that goes up, there, I think it was about the sort of rapidity of it rather than the fact that it wouldn't be sustaining. But in a sense, it might not have been sustainably insurable if they were going to have to raise rates so much that that the governments weren't going to let them do that. And so yeah, so that's what I would say about the audit. I mean, obviously we don't have the capacity to look into the mind of them, and they didn't, they haven't. But that's my sense about what's going there. And whereas with ransomware, I think it's more about the unpredictability. Because as they're still making money on ransomware. They're just sort of freaked out about the possibility of it being, not sustainable. Especially when it's state sponsored, but once again, we don't have a theory of what makes it not sustainable that would be different than the sort of general economics of what's insurable. Too catastrophic it has to be, and not too expensive that people won't pay for it.
Just as a follow-up, I think what you say resonates a lot with the idea of the rate regulation being a significant part, which to me then suggests, that maybe, I don't remember that being emphasized as part of the story.
Yeah,
but
we should
to
probably
me
do that.
that does sound like an important point that would differentiate it from, say, other settings where, as you know, with like climate, right? For instance, where I tend to think the increase, but sustainable increase, doesn't create those incentives, in part because I think there are way fewer constraints on insurers in their rate over time.
Yeah, I mean, maybe homeowners might be a little bit of an exception, but if it happens slowly enough, it probably is sustainable, right?
Yeah.
Okay, I see Omri's hand, so Omri, you're next.
Great. Very briefly, I know we're out of time. Tom, I love this paper and the whole project it's part of. The example of art theft and precaution against art theft made me think of the question of optimal precautions and the possibility of excessive precautions. You read about how collectors of high-end art lock it in warehouses, and so it's not displayed. That's a big social cost that is potentially imposed by insurers. I can imagine that sometimes that some of the precautions impose negative externalities on people who are not criminals. You want to go into places and you have to go through security because the insurance requires us. I'm just making this up, but maybe the insurance requires us to engage in these security measures. There have been studies, in 25 years ago and ongoing about the social cost of property crime, and it turns out that massive cost is not the losses themselves, things that are stolen, but the precautions that people take.
That's interesting,
overshadow the cost of
right.
the cost. So, is this something to worry about?
Yeah, no, I love that observation because we've been so focused on insurers providing sort of like too little incentive, and so therefore you can't expect insurers to be sort of effective private governance. But you're saying, wait a minute, and sometimes are they providing too much? And that is super interesting. And and I don't know. I want to think about it. I'm sure there must be examples, right? There have to be. And it's part of what's going on is, as you know more than anyone else, like we're all sort of in this scholarly conversation where we're trying to figure out, is insurance good, is insurance bad, or whatever. And so yeah, that's great. I just want to think more about that. Yeah, that's great. Yeah. Okay. And yeah, if you think of examples, let me know, because and to the extent that people are locking it up because they can't, they don't want to pay for the insurance, or they don't want to do what the insurance company says they have to do, that would be a perfect example in the auto context. In the art theft context.
Well, we do have it in the ransomware context, that people just don't want to go through the bother of identifying themselves multiple times, and people didn't want half of their emails to be filtered out because they might have dangerous content, and they just didn't bother with the security settings. So we always thought of it as insurance is not working properly, but on the other hand, in our enterprise paper, we were saying that was probably a good thing at the time, because it allowed businesses to get on with the business of making money.
Right. That's interesting. Right. So in that case, it's negative because it means that people don't get to take advantage of the loss spreading that would be beneficial.
I think with cyber and the ransomware, there's also an element of, because this is new, people are unwilling to accept the cost of insurance and unwilling to accept that ransomware is even a thing. They'd rather pretend they don't need that insurance until things happen. And it's the same thing with a small company. To put all the things in place that the insurers require for underwriting for you to get ransomware insurance, that I think that's another reason they abandon it, like Anja was saying.
Right. That's, yeah. Great.
Okay, well, it's after 5 o'clock, so you don't need my permission to disappear electronically if you want to. But Tom, are you willing to stick around for a little bit?
Oh, I'm willing to stay. I'll definitely stick around. This is,
cool. All right, so stay if you can, leave if you must, and we'll see you in 2 weeks, hopefully.
Great.
Can I just ask a follow-up on Dan's question about price flexibility? Because it seems to me like part of your story is like, okay, take like the immobilizers.
Right.
Why, if you could make your policyholders safer, you could charge them a lower premium and attract more people. And so why is there something about you can't lower the rate, or like what doesn't pricing take care of some of the problem of what's sustainable? Or going the other direction, can you raise, aren't there times when you can just raise prices and that makes it sustainable to the extent that you can do that?
Yeah, I'm thinking.
So with the immobilizers, the first thing was you had to actually create the technology. So in whose interest was it to put all the resources into creating the technology and the standards? And then the insured didn't really care about their cars enough to do things to protect their cars, and the manufacturers just thought, well, a stolen car is a new sale, as far as we're concerned. So to try and put this into the cars as a built-in solution was the preferred option for the insurers, which is why they went via the government. Because putting an immobilizer into the car exposed is really very expensive compared to building it in the first round. So to engage everybody on that project, they had to go effectively through regulation.
So there's kind of a behavioral flaw that the car owners themselves would actually benefit from this, and they should be willing to pay for it, and they might even get lower premiums in addition, but they just don't compute the risks right, or something like that.
Yeah, they're not really that bothered if they get the money and then they get to drive a different car.
Okay, I guess.
I mean, it is interesting, and it would, like, we don't really know how the social welfare sort of worked out, right? In other words, we don't know what the additional cost was of the immobilizers and how that translates into avoided thefts. We don't know that. We have an intuition that it worked out well, but it could be, from Omri's to pick up on Omri's question, it could well be that it was sort of like too much. Now, the thing about cars being stolen is there's plenty of externalities to that maybe, even like, I mean, like one externality that I sort of really hadn't thought about until I got involved in this project was, some young kid like steals a car for a joyride, and all of a sudden they're a criminal and they get caught and they've like go to crime school in jail, and that's their whole life and it's ruined. And so if you can stop that kid from doing that stupid thing, that by having immobilizers, that's a good thing. So I think it's hard to do the social welfare analysis, but it is certainly when it comes to auto, if we can tell this story about inability to raise rates quickly to deal with that problem, that would, kind of avoid the whole question of, what that is it really, maybe it's not really behavioral. It's just that, although I guess even that would be behavioral, because it would be that in that case, even more reason that the policyholders should prefer to have the technology so that their insurance prices don't go up. So yeah.
Sasha has patiently had his hand up. Go ahead, please.
There we go. Hi, Tom.
Hey, Sasha.
So I really
waiting. I'm waiting for your cyber report.
It's coming. It's coming. I really like the comment about how insurers don't have an incentive to minimize crime, but to standardize it, or to make it consistent, I guess, in time and in amount and stuff, right? That's good for them. And then Dan's point made me think, well, I wonder if with ransomware, I wonder if that's testable, right? I wonder if we could find evidence of carriers doing exactly that. And I was trying to think if these brokers, these ransomware brokers, right, the intermediaries, kind of act like that. Maybe not deliberately, but maybe that's the kind of effect that they have. They sort of slow down the process, right? You kind of regularize it, you standardize it, you create these payments, right? The criminals are assured that there's going to be payments made. It kind of works in a process, and you create this flow. You get this workflow. And I guess I don't know exactly how you would measure it, other than just to say, look, these intermediaries might be providing that service and creating that effect. But I was really trying to think if that's sort of testable in any kind of way. It's really a great insight.
Yeah,
Well,
I mean,
that's certainly
that's the story that Anja tells in the K&R market for sure.
Yeah, there is a focal point, and if you get kidnapped in a particular area, it's 5 days and $30,000, that nobody needs to panic, and that's predictable enough and affordable enough to be insurable. But I haven't yet quite seen that yet with ransomware. But yeah, that's where ransomware started. It started with a button say, please pay one Bitcoin.
Right. But the question is, are these intermediaries being stood up because of that, right? In order to create that effect, to slow down the payments and to standardize the payments? Or was it just sort of a circumstance of the market? And I suspect more just the latter, rather than a strategic effort on the part of carriers, right? Carriers didn't create these intermediaries.
They fund them in the sense of, I mean, they'll pay for them, but they don't.
Right.
Yeah.
But what a great, so I don't know what the question is in that. I just think it's a really great insight, and I wonder if there's any way to sort of test that, either in cyber or in any other markets.
Sounds like a Rand thing, it's like, I'm not good at, I'll be the first to say I'm not good at thinking about ways to sort of quantitatively test things, but
yeah.
but I'm not bad at coming up with crazy ideas that could be testable. So,
Okay. Well, maybe we can work on that. Anyway, great.
That'd be
Thanks so
great.
much.
Thank you.
Well, thank you so much to everyone, especially to Tom and Anja, for a terrific discussion and great paper. So we'll come back again, and thanks again. See you guys later.
Thanks. Bye.
Thank you.
Thank
Thanks,
you.
Tom.